Hey, my friends, Barry Burns here, talking about Fibonacci retracement in your trading for day trading, swing trading, Forex, stocks, futures, whatever. This is a universal drawing tool that is used by a lot of people. However, I'm going to propose an alternative for you to experiment. You decide which one you like better. I would not recommend using this along with Fibonacci retracements. This would actually be a replacement, an alternative way of finding retracement levels in the market, and it was used by the very famous trader W.D. Gann, and he is one of the most famous traders of all of history. Feel free to check him out, Google him or whatever. And he did not use Fibonacci retracements. Here's what he used, something very similar. So you go up here and you probably have to do this yourself manually. So go up here to Fibonacci retracements and you draw them in. Okay. So we go from that high to that low. Now we're going to have to change this. I've already done it in mine. But I'll show you what it looks like. So template, I'll put load. There's my Gann levels. So WD Gann, this is what he used. And by the way, I'll just pull them up here for you. Well, no, I don't need to do that. They'll be on the chart for you. Okay, so there you go. So these are what they are. Now I'm going to read out of his book to tell you how he prioritized these. This is from, well, one of his books, 45 Years in Wall Street. Okay, and in 45 years in Wall Street, that's a long time. I think he earns our attention to have that much experience, but let me also let you know that this was a long time ago. So this, he traded like in the early 1900s. So this is, yeah, many moons ago. All right, so we're talking really like literally 100 years ago, right in that ballpark. So you may want to modify this or not, but some things hold true for long periods of time, maybe even our universal truths, and other things not so much. So here is what we got. Let me get my little, we'll use red today. Red for our little markers here. There we go. I'm trying to grab it. Okay. So here are the lines he used. Now, he said the most important resistance level is 50%. So for him, that's numero uno. That's number one of the retracement levels. 50% is the most important of any high or low price. Okay, so for him, that's top one. Now, that is not a Fibonacci level. Let's note that. If you are a Fibonacci purist, you are not using 50%. And I would agree with W.D. Gann. I'm sure he'd be thrilled to know up in Trader's Heaven right now that, Barry Burns agrees with him. But I do. And a lot of traders do. In fact, a lot of people who use Fibonacci retracements, they throw 50% in there as a retracement level anyway, even though it's technically not the Fibonacci ratio. Now, I've heard people argue that there's some, way that they finagle around to say that 50% is, but believe me, they got big imaginations. They're really working it really hard. Second level is 100%, all the way down to the bottom. I think we could all agree with that. That just, to me, is kind of basic, obvious that, hey, that was a major swing low, so a lot of people are going to see that. If it retraces all the way down there, then, yeah, there's going to just be the mass psychology of, oh, are we going to break down below this low or not? So that's of second importance. He rates these in order. Then he says third of importance is 25. All right, so 25 is third importance. Again, that is not a Fibonacci ratio. Fourth of importance is 12.5. Right there, that's not a fib level. And then here's one that seems surprising to a lot of people. Fifth in importance is 6.125. Wow. So, that's a very shallow retrace, right? That's a very shallow retrace. This might surprise some people. So, that's just going from here down to there. Now, he does qualify that and says this is only used when the averages or the individual stocks are selling at very high levels. Now, the next thing, so, he's looking, that tells you that he had a very bullish bias or looking for trend continuations. He's looking for shallow retraces to find a continuation in a market. And sometimes the markets do that. Now, this time, obviously, not so much, but hey, we had a pandemic happen in here and we had a lot of other things going on in the market. So, yeah, just crazy things. And he went through a lot of crazy stuff too. Believe me, this is a very interesting book. Again, it's called 45 Years in Wall Street if you want to read about it. And you'll see that he was dealing with a lot of the same kind of stuff that we do today. In fact, one of the chapters in here is called, kind of interesting, so this goes back to, the 1930s and 40s. And chapter 1 in the book is called, Is It More Difficult to Make Profits Now Than Before 1932? I just find that kind of amusing because people today say, well, isn't it harder to make money now than it was before? Didn't it used to be easier because, now we've got algos and quants and HFTs and all that kind of stuff. People were asking that same question way back then. So it's like hilarious that people still ask the same kind of questions. Okay, anyway, so now here is a real distinguishing factor between Gann levels and Fibonacci. So, with Fibonacci, the golden ratio, the primary one is 61.8, right? He says, now the closest one he's got to 61.8 is just 66.6. And he says that's sixth in importance. Sixth. Kind of interesting. 66.6 is sixth in importance. A lot of sixes there. Sounds kind of evil to me. I don't know. Might be a conspiracy theory there. Although, happened to work pretty darn good. So, can't argue with the truth. By the way, you'll notice I have you can't notice. Okay, this is a weekly chart. I guess you can't see that. Gann traded on very, very long time frames. For him, a weekly chart was considered a short-term chart, by the way, just to let you know. Just a little extra side note there. So he's very much not in sync with Fibonacci on this basic level. I mean, again, that's close. So you see a lot of these areas are close to what Fibonacci are. But his ratios are very simply, if you look at it, it's, 25%, 50%, and then you got, so it's basically quarters and thirds, if you think about it. Quarters and thirds. And that's how he looked at it. And that kind of makes sense, actually. There's a lot of, and by the way, he also used 75%. So quarters and thirds, I'm not going to draw 75% in here right now because it didn't really do anything on this particular chart. So quarters, he went from 0, 25, 55, and 75, which I didn't draw in because, again, didn't plot on the chart. So those are your quarters. Your thirds are 33 and a third and 66 and a third. So very, just very geometric, quarters and thirds. And I think there's a lot to that because it just has a lot to do with mass psychology. When you think about it, how do people respond to things? Well, they think, oh my gosh, I'm down 25% of my money. I've given back 25% of my money. They're going to respond. That's just these are the fractions that are in the mindset of the masses, quarters and thirds. And that's why I kind of like it. It makes sense to me just because it resonates with the fractions that are in the mind of human beings. And again, just roughly, right? People are not looking to the penny or the pip, but yeah, they're saying, hey, if I lose a quarter of my money, if I lose half my money, oh my gosh, I lost 2/3 of my money. Then they freak out, they respond, they buy, they get out, they sell, they take profits, whatever. So I think there's a logic behind it that lends itself to take a look at it. So there you go. Try it out for yourselves. See if you like it. Hope you enjoyed this video, found it helpful, something else to test and try in your charts. If you'd like my rubber band trade, which I give away for free to the trading community, it's a complete trading setup. Happy to give that to you. Just go to rubberbandtrade.com, pick it up, and it's my free gift to you.